Hi, welcome to my YouTube class. As we are discussing the depreciation, today I will show you a practical problems that how you will solve it under two methods. That is when depreciation is charged directly to profit loss account. Second method, when provision for depreciation is maintained. Okay. So let's come to the problems. There is a practical problems solution. That problem solution is most important. As we are discussing in theory, we are talking in theory. We are not unless until we will show the problems, you cannot do the proper practice. So that's why it need the solution of the problems. Understanding of the problems is one thing in one side, in the other side that is the solution of the problems. Practical solution to the problem. See, I have taken an example. A machinery purchased, a company purchased a machinery for rupees 2 lakh on 1st October 2016. Okay, so machinery purchased for rupees 2 lakh on 1st October 2016. Rate of depreciation is 10% per annum charged on original cost. That means straight line method will follow. Then accounting year ends on 31st March every year. On 31st March 2019, the machinery was sold for 1,20,000. So machinery purchased on 1st October 2016 and machinery sold on 31st March 2019. So machinery account for 16, 17, 18, 3 years. That means 16 to 17, 17, 18, 18, 19. So complete 3 years. You will show it, and I show the format. That is the prepare machinery account. So the machinery account. So under the first method, that when depreciation is charged to profit and loss account. See how we do it. You have to prepare the machinery account, and there is the ledger account. There is the debit side, credit side. That debit side, date, particulars, ledger folio, journal folio, amount, date, particulars, journal folio, and amount. See that how we show it. Machinery purchased on 1st October 2016. So debit side 2016 October 1st. You will write here October 1st. So that is to bank account. Purchase of machineries. This is 2 lakh rupees. Okay. So that is the first transaction completed. I think you are clear. Machinery purchased to bank 2 lakh. So accounts closed 2 lakh. That is 31st March 2017. That is October 16, 31st March 17. Depreciation charged. So by depreciation account, depreciation here charged is 10% per annum. So that is 2 lakh into 10 by 100 into 6 by 12. Because 1st October to 31st March it is 6 months. So that is the October, November, December, January, February, March. So it is 6 months, 10%. So this is 10 by 100. So 10%, 20,000. 6 by 12. So 10,000. So this is 10,000. Is it clear? So that is the then remaining by balance carried out. So there is 2 lakh minus 10,000, 1,90,000. So this is 2 lakh. Okay. So first year it is closed. 2016, 17 closed. Again 1st April 2017. To balance brought down. So that is 1,90,000. So this balance is to be brought forward, 1,90,000. So again, 31st March 2018. So this is completed. Then second year, no other machinery purchase. If other machinery, another machinery purchase, then 2 bank account. So as the first transaction is there, same it will continue. Since no other machinery is purchased, so we are continuing with that. So that is the by depreciation account. That is depreciation charged on original cost. That means straight line method. We are following straight line method. Original cost it is given. That is the original cost. So straight line method will be followed. So when straight line method is followed, that is the rate of depreciation. Amount of depreciation will be remain same. 10% of 2 lakh for 1 year. So that is 2 lakh into 10 by 100. So that is 20,000. So this is 6 months. This is 1 year. 20,000. So remaining by balance carried down. So 1,70,000. So this is 1,90,000 total. This is 1,90,000. This is clear. So again, on 2018, 1st April, that is 2 balance brought down 1,70,000. So this balance is to be brought forward. So this amount is to be brought here. Again, this amount will be brought down here. So balance carried out, again balance brought down. So 31st 2019, 31st March 31st. So 31st March 2019, see, first you will charge the depreciation by depreciation account. That is 20,000. Because 2 lakh 10%. So that is 20,000. Then by bank account, machinery sold for 1,20,000 on 31st March. So there is depreciation charge. Then machinery sold 1,20,000. So total 1,70,000. Make the total debit side 1,70,000. But here 1,20,000 plus 20, that is 1,40,000. 30,000 is loss, shortage. So there is the loss by profit and loss account. That is loss on sale. So there is 30,000. So directly it is calculated 1. Thus no need to calculate the separate. So here it is directly calculated. 1,70,000 remains. 20,000 depreciation charge. Then sale price is 1,20,000. So remaining is loss. So this is clear. So this is about the first method on which depreciation charge to profit and loss account. Another account you can prepare here, depreciation account. Just here depreciation, by depreciation you have written in depreciation account, debit side, 2 asset account, 2 machinery account. The name of the asset you have to write, that is the machinery account. Then by profit loss account. Again 31st March 2018, 2 machinery account, then by profit loss account. So on 31st March. So every entry on 31st March. So that is the simple. The first method it is over. Then let's come to the second method. If depreciation provision is maintained, then how will show it? So there is the machinery account. Same machinery account you have to prepare. Another account, provision for depreciation account you will maintain. So that is the 1st October 2016, October 1st, machinery purchased. So 2 bank account, this is 2 lakh rupees, the same thing. But here depreciation will not be charged to machinery account. So in provision for depreciation, depreciation is not directly charged to the machinery account. Rather than it is transferred to the provision for depreciation, then provision from depreciation transferred to profit and loss account. So machinery will be shown at the same price. No depreciation will be shown here. So that is on 31st March 2017. We will show here that is by balance carried out. So that is 2 lakh. That is 2 lakh. Because no further depreciation will be charged here. Depreciation will be charged in the provision for depreciation account. So depreciation account debited to provision for depreciation account. So provision for depreciation credited by 31st March 2017 by depreciation account. That is 10,000. That is for 6 months. Because 1st October it has been purchased. So that is 2 lakh, 10%, 6 months. So that is 10,000. So 31st March 2017 to balance carried down. That is 10,000 to balance carried down. So this is over first year. Second year. So that is the 1st April 2017 by balance brought down 10,000. Again 31st March 18 by depreciation account 20,000. So total 30,000. So that is 31st March 2018 to balance carried down. This is 30,000. Well, this is the second year. So this balance is to be balance brought down. Then second year depreciation, that is the whole year depreciation is charged. Then total amount is transferred to balance carried down. So again 1st April 2018 by balance brought down 30,000. Again 31st March 2019 by depreciation account 20,000. So total this is 50,000. So this 50,000 31st March 2019, that is machinery is sold as per depreciation. So to machinery account, this is 50,000. So this is the provision for depreciation is prepared. So here again 1st April 2017 to balance brought down 2 lakh. Because depreciation will be not shown here. Depreciation already shown in the provision for depreciation. So this 2 lakh again 2018 by balance carried down 2 lakh. So balance brought down, balance carried down. Just you do it like this. Fill it. Machinery purchased or sold. New machinery. If new machinery, another machinery purchased here to bank account, again by balance carried down. So this is like this. So 1st April 2018 to balance brought down. So this balance carried down becomes balance brought down. This balance becomes brought down. 2 lakh. Again 31st March 2019. So this is the crucial date on which all the transaction is to be recorded, because here depreciation is transferred. From provision for depreciation to machinery account. Again, machinery is sold on 31st March 2019. So all the entry will be done here. This is most important record. Okay. So that is the first by provision for depreciation account. So this provision is transferred here. This is 50,000. Again, that is by bank account. That is the sale 1,20,000. So total 2,50,000 plus 1,20,000, 1,70,000. So remaining that is by profit and loss account. That is loss 30,000. So total 2,00,000. So this is 2,00,000. Machinery is closed. So this is how you will do the recording of transactions. That means balance total is here. Total provision for depreciation calculated here 50,000. Here completed. Machinery sold means this total amount of provision for depreciation transferred to machinery account. So that is by depreciation because machinery is sold. If machinery is not sold, it will not be transferred. Remember, when machinery is sold, if part of the machinery is sold, then part of the depreciation, provision for depreciation will be transferred to machinery account. That means suppose say of this machinery, 50% machinery is sold. Means half of the machinery. Half of the machinery is 2,00,000, half is 1,00,000. So accordingly, half of the provision for depreciation total is 50,000. So half of that 25,000 will be transferred here. So remaining will be kept here to balance correctly. So again by balance total. So like this it will goes. So this is the how you will record the transaction. That is, if depreciation is charged directly profit loss account, if depreciation is transferred through provision for depreciation account. So this is the straight line method we have taken. If written down value method, accordingly you will show it. Written down value method, first depreciation charge remaining 1,90,000. Again 10% of 1,19,000, 19,000. Like this it goes. So only the difference is in the amount of depreciation, not in the recording or the accounting procedures. This remains same. There is no different. The same process will be for written down value method. Only the difference is amount of depreciation you will calculate. So hope you have understood this practical problems, how we solve it. Do the practice, more perfection, complete more and more as more problems in your book, then you will follow it. As we are discussing about the practical problems on depreciation, the first problems I had shown on straight line method, how it shows in the machinery account and how it appears provision for depreciation as well as machinery account. The same problem we are continuing with the written down value method. So if written down value method, then how it will shows. So that is the most important thing to solve the problems, practical problems. Let's discuss about the problems that when written down value method is to be used, how the machinery account will appears if depreciation charged directly to profit loss account, and how it appears provision for depreciation and machinery account if it is created through provision for depreciation account. Okay, so let's discuss. So the same problem, machinery purchased on 1st October 2016 for 2,00,000 rupees. So that is the 2016 October 1st. That is the first entry. That is to bank account. That is machinery purchased for 2,00,000 rupees. Okay. So accounting year ends on 31st March every year. That is 31st March 2017. So depreciation charge by depreciation account. So this is depreciation 2 lakh rupees into 10% into 6 by 12, because it is 6 months is there. So 6 by 12. So that is the 10%. That is 10,000. Okay. So remaining by balance carried out 1,90,000. So this is 2 lakh. First year completed. This is the first year transaction completed. Again, 1st April 2017, balance brought forward to balance brought down 1,90,000. Again, 31st March 2018, by depreciation account, that is on 1,90,000 into 10% for full year. Because written down value, the balance which remains on that balance, 10% depreciation will be charged. So it is 19,000. Remaining balance carried out. So that is 1,71,000. So that is 1,90,000. Okay. So this is second year completed. So again, third year, 1st April 2018, to balance brought down 1,71,000. So this balance brought forward here. That means this 1,90,000 here, this 1,70,000 will become here. So there is 31st March 2019. So that is by depreciation account. First depreciation will be charged for the whole year 1,71,000 into 10%. This full year 17,100. So remaining, that is machinery sold by bank account 1,20,000. So remaining is by profit and loss account. This is loss on sale. So there is first year depreciation charge 10% on 2 lakh for 6 months. So then remaining balance 1,90,000. So on that 10% will be charged here 19,000. Then third year again depreciation charge on remaining balance 1,71,000. So on 1,71,000, 10% whole year 17,100. So machinery sold 31st March 1,20,000. So 1,20,000, remaining is the loss. So that is the loss. Total 1,71,000. It should be 1,71,000. So loss is 33,900. So this is the loss. The total loss 33,900. That is debited to profit and loss account. So in written down value method, so depreciation charged on the remaining balance left after the depreciation charge on the assets. So after the depreciation has been charged, the remaining balance will be left on that depreciation charge. Like this it goes on. So at the last it is to be found out what is the total loss. So this is for direct machinery account and depreciation account when depreciation charged to profit and loss account. If provision for depreciation and machinery account is prepared, then see like this how it happens. So that is the first October 2016, that is to bank account. So machinery purchased to bank account, that is 2 lakh. So remaining balance 31st March 2017 by balance creditor, that is 2 lakh. The same balance will be carried forward. There will be no changes because provision for depreciation is charged. So this is 2 lakh. Again, on 1st April 2017, to balance brought down, this 2 lakh. Because balance carried on, balance brought down, again 2 lakh. So 31st March 2018 by balance carried on, again 2 lakh. So this is completed. First year, second year, same thing, no changes. Again, 1st April 2018, to balance brought down, is 2 lakh. You can see here the same balance is brought forward, carried forward, while provision for depreciation is maintained. So this is brought forward till this. Stop. Let's complete the provision for depreciation till this date. Then we'll proceed the last year. That is on 31st March 2019. That will be completed after this account will be finished. Otherwise, there will be mistake. Because this depreciation will be transferred to machinery account when machinery is sold. So first, let's prepare it. That is 31st March 2017 by depreciation account. That is 2 lakh into 10% into 6 by 12. That is 10,000. So this is the first year depreciation, 6 months. So 31st March 2017, this to balance carried down, that is 10,000. So this is first year. Second year, 1st April 2017, by balance brought down 10,000. Again, 31st March 2018, by depreciation account, this 90,000, because 1,90,000 into 10%. So 29,000. That is 31st March 2018, to balance carried down 29,000. So this is the till 31st March 2000. First year 6 months depreciation, second year full depreciation 19,000. Then third year again 1st April 2018, by balance carried brought down 29,000. Again 31st March 2019, this is the last year, by depreciation account, that is 1,71,000 into 10%, that is 17,100. So total 56,100. So that is 31st March 2019. This to machinery account, because the machinery is sold. When machinery is sold, total provision for depreciation is transferred to the machinery account on the date of sales. So on 31st March 2019, machinery is sold. So it is transferred to machinery account. Total is 46,100. This is 46,100. Okay. So now 31st March 2019. So that is by provision for depreciation account 46,100. This is depreciation. This amount goes here. Then by bank account 1,20,000. This is sale price. Then remaining by profit and loss account, there is loss on sale. So this is calculate the difference amount. This is 2 lakh. This will be 2 lakh. So 900 be 33,900. This is the loss calculated as per the written down value method. We have shown 33,900, depreciation 46,100, provision for depreciation under written down value method. But under straight line method, what you have seen, the total provision for depreciation come up about 50,000. Loss is 30,000. Whereas under written down value method, the loss increases 3,900, depreciation decreases by 2,900. This is the difference. So under written down, you can see the comparison between straight line method and written down value method. Under straight line method, the depreciation, total depreciation comes 50,000 under straight line method. Under written down value method, come of depreciation, total depreciation is 46,100. This 3,900 increases as the depreciation decreases, loss increases under written down value method. But under straight line method, as depreciation increases, loss decreases. But under written down value method, depreciation decreases, loss increases. This is the difference of the two methods. I had shown you the practical problems, how you will solve it under straight line method and written down value method. So under the two methods of recording, one is your first one, that is the when depreciation directly charged to profit and loss account, when depreciation is credited to provision for depreciation account and maintaining the machinery account. Hope you had understood the problems and do the practice, and more you will perfect. Thank you.